Hello everybody, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion on the local, national, and global economy and how it impacts your personal, financial health, and wealth. Now here's Taking Stock, episode number 71, and I am so happy to welcome with us once again Art Jarvis. How are you today?
Better than I deserve. How about you?
How about that? I love that. I'm equally better than I deserve. But so thank you for that. Doing well.
Good.
Doing well.
Glad to hear it.
And we can dive right in and talk about doing well.
Yeah.
And I know you said you wanted to really hit on the point of continuing to do well. We'll put it that way.
Yeah.
So what's happening and what's the message to our listeners?
Yeah, the funny thing is 2 weeks ago we were in a market that was down almost 7.5% for the year because of everything that was going on in Iran and things. But in those 2 weeks, the S&P 500 has risen 500 points. The market is now up like 5%. So we've had like at least a 12% swing from the bottom to the top just in 2 weeks. So basically we're looking at 10 trading days, And I know we've talked about in the past that, there are times, the Great Recession of 2008 and things like that, the dot-com bubble, great examples of it's time to get a little more conservative, things like that. But, these last 2 weeks of trading are just the epitome of, if you miss a very short period of time in the markets where you get into a rising market, you end up missing the majority of the returns for that year. So, now again, we're up 4.5% or whatever for 2026, but we've come from a body, within there is a 12% move in 2 weeks. Right. So, there were a lot of opportunities, and don't get me wrong, what is going on over in that part of the world, we're not out of the woods yet. There's still an opportunity for someone to do something not so smart, and but we tend, especially last year, and I know you had mentioned we might talk a little bit about tariffs, but like last year with the tariffs, we quickly took 20% out of the market in a month and a half over what I generally consider a bunch of nothingness, right?
Right.
This thing here actually was, it's funny. Our president came out just yesterday or this morning and made the comment that he was surprised that the market didn't drop 20% during this whole fiasco or whatever you want to call it.
During the month of March.
Yeah.
Well,
number one, I don't quite understand why he would even say those words, but but he did, and I'm not really. We're kind of like, I was surprised during the bombing and the things that were going on that the market really kind of hung in there, and then kind of towards right before we met a couple weeks ago, the market, that's when it kind of went from down 3 or 4%, all of a sudden it was down 7.5%.
Right,
but here we are 2 weeks later, and guess what? We're back to making money. The corporate earnings are fantastic. I mean, the year over year and the quarter over quarter, the positive surprises in the S&P 500 earnings is great.
Well, the political naysayers, as opposed to economists.
Are there some of those out there?
I've heard some. I'm pretty sure, maybe just one.
One very loud one.
Maybe just one political naysayer.
Oh man!
But you just said the corporate earnings, doing great. Well, so the political naysayers, of course, because this administration takes care of the big corporate guys, and they're killing me and you. Well, I'm just saying.
Yeah.
I'm just saying. Yeah. You touched on this a second ago, Art. Was you were surprised that with the bombing and everything that was going on, that we didn't see, the market lose that 20%. Mm-hmm. But all throughout that time, we did 3 episodes of Taking Stock. over 6-7 week period. And you continued to talk about, you didn't really express total surprise, but you continued to remind the people, hey, it's not like we're losing 20% here. The market, people are hanging in there. So you were taking note and, want to lend credibility to what you do. Again, Art, you told us during those 3 different episodes over the 6 to 7 week period of time that, look at the market, it's hanging in there.
Yeah.
And I think that, again, twisting and winding through all of what you just shared with us been going on is that message again is like, stick to your plan.
Right.
It's not, if I listen to Art Jarvis, and if whoever you are listening right now, listen to Art Jarvis and others like him, you would never get out. There's never a good time to get out of the market. I like the way you've explained it. I learned this lesson from you in these episodes. There are times to take some, what do you want to call it? Take some, I forget the word, but take some profit.
Yeah. Take some money off the table.
Yeah, take a little bit of profit.
Yeah.
There are some times, but don't get out.
Right.
Don't blow up your plan. Stick to your plan. There are some times to take some profits. And I think what I learned though is like taking those profits isn't necessarily like, okay, let's just pull that money out and stick it in the mattress.
Yeah.
Which absolutely not. Or even stick it in a savings account or something. It's move that money. Take some profits off the top of something and move it, if I got that right.
Yeah, definitely. And there's nothing wrong. There is a such thing as sectors and securities and things that get a little bit ahead of themselves. I do kind of this is organized gambling basically. And it's sometimes takes if you have a security that doubled, take some money off the table and play with the house money.
Right.
So and then take that money you took off the table and hopefully move it to a sector or a security or something that's been neglected. But you know what the hardest part about selling or getting out of the market is?
I don't.
Getting back in the market. Okay?
Actually, I do know that because you've told us a million times, but it didn't stick.
So I had an interesting conversation with a client, I guess it was last week, and they had brought up about wanting to pull some things out of the market and get more conservative and things like that. And actually, we were almost down 7.5%, which I always find interesting that we're having these conversations real close to the bottom or potentially the bottom. But my point I made to them was that, they said, and their comment was, we can get back in the market when things look better. But here's the problem. The market starts going back up before things start looking better. Right? I mean, this is a great.
So you're taking out your losses, right?
Potentially,
you're taking out losses, and then trying to buy back in after the gains.
Correct.
Yeah.
Which is honestly the way a lot of people do it. That's true. Because people go through fear of losing, and then they wait way too long, and they get into fear of missing out. Well, guess what? Generally, they're selling really close to the bottom. They're buying back in real close to the top. So, but the point is you just, again, I'll say it one more time. There are times where bad things are coming down the road, and you need to make adjustments. Okay, but there's a whole bunch of other things where I'm not enjoying this, and it doesn't really look that good. But we completely overreact to things, and to me, once again, with volatility comes opportunity, with chaos comes profitability, right? So it's just the hard part is getting back in. I want to get back in when things look better. Well, the problem is it spent the last 4 weeks moving up before things actually started looking better. So guess what? You missed out.
Right.
And by the time you got back in, you already missed, especially in this case. If you were waiting for it to get to kind of the way things are today, well, you already missed a 12% move.
Well, that brings us full circle around to 10 minutes ago in this conversation, where there is this small window where if you miss that, you've kind of missed.
Yeah.
And so, not saying the last 2 weeks where that's it, but that was an example of one of those windows where, like 2 weeks ago was the time to buy that blue light bargain.
That's right. Yeah, doesn't like your blue light special.
And look at where it would be. I mean, if you started at zero, 15 days ago, and said, you know what, I think I want to get in the market, and you took whatever sum of money, your first dollar into the market, and you bought something for $1, that stock or whatever it was you bought at $1 15 days ago is already at whatever it is.
That's right.
It went up.
Yeah.
You bought in on that blue light special and turned your dollar into some more money.
Yeah. And not only did you get back to where you were before, you came back faster.
Right.
Because you bought at a lower price. So not only did you get back to where you were, you got back to where you were quicker. And now you're even further ahead. There's a saying, the markets have a lot of sayings, but one of them is that the market climbs a wall of worry. Right. And it's true. There's always something to worry about. We're not even done. Again, don't get me wrong. There's still some stuff. We still have some work to do over in Iran and things like that. Obviously. But and the whole back and forth on the ceasefire, and he did, she said, that's not a big surprise. That's going to happen. But but then we're already talking about the next thing. Okay, now we're talking about Cuba. Well, guess what? This isn't going to get over, and it's going to be cupcakes and gumdrops all of a sudden, right? We're already talking about the next drama. So we'll see where that goes. But it's. You have to pick and choose, and again, that's why I look at the economic numbers and pay attention to the trends in the numbers. And if the economic numbers are not fitting into what the rhetoric is, I'm going to go with the numbers. Okay, so now that doesn't mean that the portfolios aren't going to bounce around a little bit because of that.
Well, this is why you hear from your clients. They hear the rhetoric.
Yep.
And then they call you, and you recite the trend-based or the numbers-based trends that support. Let's keep doing what we're doing. You don't worry about what you're hearing. Look at what we're seeing in the numbers, right, and the trends from those numbers.
Correct.
Yeah.
Very much so.
And you've been doing this for what?
Couple years.
Couple days. Oh,
Yeah.
couple
decades. More. Yeah. Ouch.
I was just gonna say a couple days, but
June 6th, actually June 7th. That'll be the beginning of my 40th year. So I've been doing it for a while.
Well, we'll have to celebrate that.
Yeah. Okay. Yeah.
Wait a minute, 40 years, and you can't do the math as age, and aren't you supposed to retire?
No. Well, yes. But no. We've talked about this. I have no intention of my plan is what I call rewirement, not retirement. Rewirement, which means, I've got a couple youngins in their 30s who are learning this business and learning how to run a company, and we're learning how to take care of people the right way and things like that, which hopefully will allow me to continue to participate in this because it's what I enjoy doing. But that's not to say that I might be making phone calls from a cruise ship too. So we'll see what happens. So, but that retirement, I talk to clients about this a lot, and when you retire, you have a game plan. If you retire and sit around the house and do nothing, that generally is not a good thing. So, I talk to people a lot about you've spent the last 30, 40 years accumulating a bunch of assets. Make sure you got a plan to enjoy them if you can. Whatever that is. For some people it's some grandiose things, and for other people it's it's traveling around the country and camping and fishing and things like that. Whatever your thing is. But for me, sitting around the house or not. I like golf, but I don't want to play 5 days a week. I don't mind fishing, but I don't want to fish 5 days a week. I'm more of a go see things kind of guy. So, I can still do what I do, enjoy what I'm doing, but, I can do it from some national park out west if I want to. So.
Well, so ultimately the message is, do things that you enjoy,
100%.
whatever they may be. Don't just sit home.
Yeah. People
Which is another piece of that. Another piece of that is stay healthy, stay active, and if you've put yourself in that position, as you said, with you accumulated some assets that give you the option to do things that you enjoy, then have a plan to accumulate those assets for a reason and do things that you enjoy.
You have to keep moving to keep moving.
Yeah.
So
maybe one of these days I'll figure out exactly what it is I enjoy.
Well, you're keeping yourself entertained up to this point, so that's good.
I'll rewire also.
You rewire. There you go. Yeah, it's people are like, well, I don't want to run out of money. It's like, part of my job is to let you know if you're getting ahead of yourself. Okay, it is, right? And it's like, if you again, this is exceptionally simple math, but if you dip into your principal 2% every year, guess what? You got a portfolio for the next 50 years. Right? So, and that doesn't include any growth you continue to receive. Some people have this concept of, on this day I'm going to retire, I have X number of dollars, and that's all the money I'll ever have. Well, no, your money should continue to still work for you. It doesn't have to be as aggressive as it maybe used to be, but you still want your money working for you, in some capacity, right?
That, at the end of the day, that's the key. If you are the only one working for money to gain assets, then that's a struggle, because at some point you can't continue working. So it's making your money work for you, which is why, how many times have we talked, on this show where we're talking to you 20-year-olds. Now's the time for you to put your money to work for you, so that you can, while you're at that great, healthy working age or whatever it is, and you enjoy your work or whatever it is, but your money's working for you, so that you have that day when you say, I can't do this job. Because people have jobs that are, sometimes physical jobs.
That's right.
And they reach a point, can't do that job anymore.
That's correct.
And you don't want to hit that day and there's no nest egg, right?
100%, yeah. Or you end up continuing to work when you don't want to work, right? So
yeah. You know what? Breaking down physically or mentally, because you can just be, overstressed. It doesn't have to be physical, but that stress will equate. That translates to physical breakdown too. So the bottom line is, all Chuck's trying to say, and all Art's sharing this example is, let your money work for you.
Yeah.
And then have a plan to enjoy that money, those assets, whatever they may be.
Yeah. And also, let's be clear. Well, a couple things. One, I'm a big fan of take your money and do some good in the world. Okay. But number two, being unhealthy is very expensive.
That's true.
So, it's hopefully you retire and you spend some money doing all the things you love and everything, and then you kind of get older and you slow down, so maybe your expenses aren't what they used to be, but then as you get even older, your expenses start to go up just because of healthcare and things like that and all the stuff you got to do which they're getting way better at. And I always say the healthcare industry is going to do some amazing things in the next 10 to 20 years, and will continue to, right? But the fact of the matter is getting old is not cheap.
I was going to say, why do you say that? Why is the healthcare industry going to do amazing things?
The things that some of these companies that we may haven't even heard of, the technologies that they're developing, the drugs that they're developing, and things like that, they will increase the lifespan, our lifespans. So if you're in your 20s and 30s right now, I'd have to imagine that the lifespans have to start getting toward, the mid to upper 80s for them, so.
I don't know.
Well, maybe we'll be around to find out. We'll see.
Well, I wouldn't dispute for a minute the idea that technology and science technology, health science technology, is growing and potentially providing a lot of different opportunities. I'll say this, like on the air, so to speak, but I am not a believer in the pharmaceuticals, as you well know.
Yep.
Art knows that. Now anybody that's listening knows. And I've been fortunate. I've been very blessed. I'm not. I have no whatever prescription medications at all. So I'm kind of that looking with a skeptical eye on that piece of it. But I wouldn't dispute for a moment the idea that some amazing things can happen in the healthcare industry. I hope among those are getting through to people how important, proper diet, proper exercise. This isn't an exercise and diet show, but I mean, I hope that more and more people are starting to understand, how our bodies work and how we stay healthy, and not to say that there aren't, oh my gosh, thank God for the pharmaceuticals that do give people a chance that might otherwise be gone.
Right.
So I'm just, but I'm just blessed so far, and I want to continue to, stay away from the prescription meds as much as I can.
And once again, as I'll say, one, you might be blessed with some pretty decent DNA, but you also do a good job of keeping moving. So
well, that's why I say I hope that that's the message that, and it seems to be. I mean, don't you think that there's more and more active lifestyle happening in all age groups?
The opportunities for retirees and things like that are phenomenal now. This isn't where you go to a retirement community and you sit around and do nothing anymore. It's
up and moving.
Yeah, I mean, these retirement communities, 55 and over communities and things like that, very impressive, So, yeah, and the other thing, I'll just throw this in there. I don't know how much time we have left, but throw artificial intelligence into this whole mix. That they're allowing industries, including the healthcare industry, to do things that may have taken years, and now they're doing it in months. So
that is the one place, Art. I'm kind of glad you said that, and we talk offline about AI and all those things, and so you personally know kind of where Chuck stands on AI and the use of it or the abuse of it.
Yeah.
But that's the place. When I first heard anything about this AI, artificial intelligence, I got introduced to it in a special report about AI in science and medicine. And I thought, wow, so that's the one place that I really think AI can be most beneficial in our world, because at some point there's a limitation to our own personal smartest minds, smartest people, but AI can take that to the next level and find a cure for something that maybe man by himself would not have found. So AI in medicine, I'm excited about.
Yeah, I agree. It's interesting. Last night, so I was putting together. I had a foundation that we've created, or a group of people have created. And last night, I went in and I in about 2 minutes, did a bylaws, articles of incorporation, investment policy statement. Okay, and it's basically about 80% done in about 2 minutes.
Yeah.
Now we have to sit down as a group and tweak it and make it ours. Okay,
Right.
so it's very, something that.
But you could call on AI for an assist and come up with that in a couple of minutes.
It was very well written, and it actually, and the thing is, it actually puts things in there that, oh yeah, I didn't put that in there, and like logistics and how things work, we're going to work. And it's like, oh yeah, that makes sense. Or this one's like, yeah, that's almost it, but we want to tweak it a little bit, right, for our specific situation. Mm-hmm. But instead of spending, 2 weeks of my evenings putting all this stuff together, it took 2 minutes, or 80% of it anyway.
Right.
So it's just, and don't get me wrong, I'm not using artificial intelligence even remotely closely to its potential, right?
Sure.
I mean, I'm just having to put some documents together for me and things like that. So,
well, kind of like it's almost like a research tool. Like Google it, well, AI it, so to speak. But I can see some positives, but the concern is the negatives, and we don't need to hit on. I mean, I'm sure if you live in this Loveland area, this greater Cincinnati area, you saw some news about how AI was abused
by far
recently. So we don't need to get into that. But they're learning.
Yeah.
And so how they're going to put whatever rules and regulations and clean it up so that it doesn't become the worst enemy we've ever had.
And the internet's been around a long time. That's another example of a tool, and that's not even close to being cleaned up. So,
well, you hinted at the start of this that we're coming to the closing couple of minutes here, so I'm going to throw this in real quick. You said that that I had plans to hit on the tariffs.
Take a little tariff.
But this, we can't take credit for this ourselves. But I did hear a report about Hyundai Automotive, and this goes to, you hinted Chuck's going to say something about tariffs. Mm-hmm. So here it is. All the criticism and everything about the tariffs and how bad and how horrible they're going to be. And so guess what? Hyundai announced they're moving production back to the U.S. because it costs them too much with the tariffs.
Yep.
So this is this kind of thing that the administration said, we want to get some things back here, and it's going to benefit us because we'll bring jobs back here, manufacturing, we'll bring, things back here, industry back here that have gone elsewhere because, they don't have to pay. They pay cheaper wages. It's just less expensive. Well, Hyundai, who by the way, to their credit, they said already 50% of production or 50% of the cars sold here in the U.S. are built here in the U.S.
Right.
But the tariffs are too much, so they're coming back. So to me, at least, that's a positive from the tariffs. And you can take all the criticism you want. That is exactly what the administration said we're trying to do, and that's exactly what's happening. That was just another example, came out in some news on this Tuesday, the 21st of April. And so I think that's another positive where tariffs are having a positive impact for the U.S. economy.
I mean, look at, here we are basically a year later since when the tariffs really got started back in February of last year. Look at the corporate earnings for the first quarter of 2026. They're great. Again, this whole tariffs is not some great big new concept. All right, tariffs have been around for a very, very, very long time. Okay, what my problem with tariffs, and we talked about this in the prior show, was there was an inequity in tariffs between the United States and other countries. So, you do it however you want, but somewhere along the line, it's like, okay, we need to make things a little, I'm going to use the word fair, because every time I use the word fair, I hear my father in my ears. But, we've been giving away a good chunk of things that we probably shouldn't have been giving away. Well, we're humans. We don't like pain. We don't like things that cause us discomfort. Well, that's what the tariff policies did. It caused discomfort. And everyone's mad at us because of the tariffs and things. And you can say, did it the right way, didn't do it the right way, whatever. But we needed to get to something that I'm going to, quotation marks, is more fair. And hopefully we've accomplished that a little bit. Now, everyone's worried about our relationship with the rest of the world, and it's like, So
yeah, I don't want your dad to yell in your ear, so we're gonna replace the word fair with just more balanced.
Balance would be good. A little parody. There's
That's another one of those famous words.
That's right.
Parody. They tend to play that one on the field of sport.
Exactly.
Parody is where we hear that word the most. But trying to bring some balance.
Yep.
I think as we're into the final seconds here, I always like to give you, Art's last word for episode number 71 of Taking Stock. And I think it's reiterating that we've said it so many times, and now 71 episodes, stay the course.
Stay the course.
Stay the course.
Man, sometimes it might not be the most comfortable thing to do, but generally speaking, it works out in your favor.
Well, today it was like, and that course needs to be let your money work for you.
Correct.
And have a plan for that retirement day. And for your 20-year-olds, the first part is the most important part. Let your money work for you.
Mm-hmm.
Don't just think of some exciting, fun thing you want to do now to spend it.
Right.
Let your money work for you so you can have those exciting, fun times.
Stay away from the credit cards.
Stay away from the credit cards.
But a 20-year-old's greatest asset is time. By far. If you're 20 years old, your greatest asset is time. So take advantage of it.
Perfect.
There you go.
Stick to the plan.
That's right.
Well, our plan is to come back in 2 weeks from today with the next episode of Taking Stock with Art Jarvis. But for today, we are at the end of episode number 71. And Art Jarvis, I thank you again for being with us, sharing your insights. It's a pleasure to have you.
Yeah, thank you, Chuck. And we'll see you for episode 72 and see what the world brings in the next 2 weeks.
Absolutely. So back in 2 weeks, but for now, that is Taking Stock, episode number 71 with Art Jarvis. I'm Chuck Gibson saying thank you for listening in, and join us again in 2 weeks. Goodbye for now.